So what is up YouTube? In today's video, I'm going to be talking about what balance sheets are. So my past two videos have been focusing on earnings reports, how to read them, why they're so important, and how they help us analyze companies. And today we're going to be talking about another financial tool that actually helps us analyze a company, which is the company's balance sheet. So in a company's balance sheet, it shows us what the company owns, what it owes, and shareholders' equity. In a balance sheet, there are three main components which we will be talking about in this video. The first is an asset, the second is a liability, and the third is shareholder equity. So an asset is something that holds value, so when it's sold, the company or the person actually gets money, or it is something that can make money for them right now, or it could possibly make money for them in the future. Let's take the company Apple as an example. They bought the company Beats for $3 billion in 2014, but now the products from Beats is actually making them money. This type of company is known as a subsidiary, where one company owns another, but that will be discussed in another video. But these aren't the only types of assets, there are many more. There are basically two types of assets that can be seen on a balance sheet. The first is current assets and the second is non-current assets. Current assets is something that is already cash or is expected to become cash within the next year. Non-current assets is something that isn't cash and isn't expected to become cash within the next year because the company is using it. For example, it could be buildings or production areas or land, and you guys get the idea. So it's usually hard assets. So now let's talk about liabilities. Liabilities are usually debt that has to be paid off, but it can be something else. But the basic idea is when you're losing money. And there are two types of liabilities. The first is current liabilities and the second is non-current liabilities. This is the same as it is in assets. So current liabilities is something where the debt is owed to its creditors within the next 12 months, and non-current liabilities are long-term debts, bonds payable, so it's longer than 1 year. Usually long-term debts are 15 to 30 years. Bonds are also 10, 15 or 30 years. So it isn't paid right away. So why are assets and liabilities of a company so important? So now during this pandemic, we could see a lot of businesses are shut down, and if they had terrible balance sheets, meaning they had more liabilities than assets, they would be in a terrible position. But for a company like Apple, where they have a lot of cash available, we know they could get through those times. So knowing between how many assets and liabilities a company has, we could tell whether the company is financially suited and well valued, and whether it actually deserves our investment. Amount of assets and liabilities also help us understand how much money a company will actually reinvest in itself. Like a company in huge debt, it will be hard to raise more capital just for innovation, but that just happens sometimes. But for a company that has a lot of cash, they could easily innovate their products. For example, Apple, they continuously revolutionized the iPhone. Now let's talk about shareholders' equity. Shareholders' equity is basically assets minus liabilities, and is calculated just in case the business decides to shut down. And it's important because it tells you how much money the company would actually get just in case they shut down. It tells you how much money would you actually get back. And for some companies, they have a negative shareholders equity, and that basically tells you get away from the business. When they don't have a good balance sheet, that's alarming sign. Unless they have great potential in the future, I suggest not buy into the business. So to sum it up, balance sheets are financial statements that are very important because it tells us if in case the business is going bankrupt. Usually when the assets and liability are one-to-one, it means the business is at risk of going bankrupt. And usually when they have a lot more assets and liabilities, then they're much better positioned than other companies in the industry because it allows them to develop their products a lot more. And also it tells us if the business suddenly shuts down, how much money we would get back. You can find a company's balance sheet if you go to Yahoo Finance, you click financials, and then on the top left corner you see something called balance sheets, and you just click on it. Now if you guys want a more in-depth video on this, comment down below in the comment section. My next video will be talking about Vector IQ, and I will be doing a stock analysis on it. And thank you for watching.